I'm Michael Waldron, Director of Portfolio Management at Heritage Financial Services. Thank you for watching my presentation of the Real Deal Economy. While this is a first quarter 2025 presentation, the first 3 weeks of April have clearly changed the narrative, and a presentation that stops at March 31st isn't relevant. Therefore, I'll often be discussing markets and the economy as of mid to late April. First, let's talk about how we position portfolios early in 2025. In our strategic asset allocation update, we endeavored to position portfolios more conservatively than our baseline. We want to cover some of the information that we used to make this decision, which showed its benefit, particularly in the post-tariff period. While we did not anticipate the catalyst being far larger than expected broad tariffs upending trading relationships, we knew that the U.S. stock market was historically expensive. In the graph on the left, you can see when we look at the forward price to earnings ratio, it tells you very little about the expected returns over the next 12 months. The forward P/E ratio of 22 in January 2025 was clearly on the high end of observations. But at this level, we've witnessed excellent one-year returns as well as significantly negative returns. Fortunately, we're managing portfolios for clients with time horizons that extend beyond the next year. The graph in the middle is a regression analysis of annualized returns over 5-year periods. Over this time horizon, the forward P/E ratio tells you a good amount about the expected returns. Indeed, it explains 1/3 of the variance in observed results. And when you use the regression analysis over 10-year periods, as you can see in the rightmost graph, the price you pay for a basket of companies compared to the earnings those companies produce explains a lot of the variance. So when we went into 2025, after 2 very strong years for U.S. equities, in which prices became elevated compared to the underlying operating results of the businesses, we reduced our return expectations for U.S. equities. We felt that it was prudent to structure portfolios with higher allocations to non-equity asset classes. In the last quarter of 2024, I brought up the issue of concentration in the U.S. equity market. As the Magnificent Seven stocks increased in market capitalization at a faster pace than other companies, they began to dominate U.S. equity market returns. The point of diversification is to ensure that one or a few companies' fortunes don't overly impact the portfolio's results. We were worried about this and thought market cap weighted indexes were constructed and suffered from a lack of diversification. Our primary strategies in the U.S. break away from market capitalization and reweight the portfolio, which we believe is a better method of portfolio construction in the U.S. equity asset class. Indeed, through April 8th, the Magnificent Seven declined by an average of 25%. Stocks such as Tesla have seen their valuations nearly halved. It's for this situation that we built equity allocations with resilience to the results of those individual companies. And indeed, we were able to cushion our investors from their fall. At Heritage, we are global equity investors. We believe international equity components are an important part of building a multi-asset class portfolio. Instead of a U.S. equity-only allocation, we start with a global expression, which was about 67% U.S., 33% international at the beginning of the year. From there, we strategically pushed further towards international markets, with approximately 64% in the U.S. and 36% in international markets. Why global, and why even more weight in international than the global market? It again comes back to relative pricing. As an illustration of this, we show the discount of the international market's P/E ratio to the U.S. P/E ratio. This discount hit a low point in the first quarter of 2025. The U.S. tariffs are not why international markets are up, although the negative impact on the dollar has been a significant contributing factor. International companies were priced at a steep discount to U.S. companies. Despite tariffs and trade uncertainty as headwinds for global businesses, in international markets, the low valuations have thus far been a stronger tailwind, keeping year-to-date returns positive. We discussed why we wanted to be more conservative in our allocation to equities at the beginning of the year. We discussed how we approach constructing a U.S. equity portfolio that addresses the concentration problem facing investors. and we discussed why we held a healthy allocation in international equities. Now the question becomes, when have those themes played out, and when do you step back on the gas? From an asset allocation perspective, we look at the 10-year US Treasury yield versus the highest inflation-adjusted earnings divided by the current price of the stock market, which I'll refer to as the earnings yield. In late 2023, Treasury yields surged higher, and the earnings yield came down. The normal relationship of an earnings yield above the 10-year Treasury yield crossed over, and we became slightly more cautious entering 2024. U.S. stocks produced strong returns again in 2024. The spread between the Treasury yield and the earnings yield yawned open to over 1%. That guided us to reduce portfolios ex-ante volatility targets in our 2025 strategic allocation update, which meant selling equities and buying fixed income. You can see in April that the gap is narrowing. The eventual elimination of Treasuries yields over earnings yield will influence our decision to reverse our conservative stance and move back to baseline. After 2022, investors kept questioning why it's desirable to hold bonds in a portfolio. We presented the total return, income, and capital appreciation or depreciation of the U.S. investment-grade bond market going back to the mid-1970s. Over 50 years, there have only been 5 negative years in the investment-grade bond market. 3 of those 5 years were between 0% and negative 2%. The worst year until 2022 was 1994, with a 2.9% decline. Now that is a stable asset class. A corollary to the pain in the bond market in 2022 is that yields rose well above the low levels that they had been at for years. By late 2023, Treasury yields provided an attractive spread to long-term inflation policy goals. I illustrated in 2024, when stocks pulled back sharply at the end of July into August, how investment-grade bonds provided not only capital preservation during that time, but also served as a risk offset. Equities recovered by the early fall, but that glimpse provided an important indication that fixed income could be negatively correlated with stocks during a non-inflation-led drawdown. And indeed, through April 8, 2025, fixed income played its role well. While U.S. stocks approached bear market drawdown levels, fixed income maintained a positive return for the year. This is exactly why we want fixed income in portfolios. As things stand, we believe fixed income remains positioned well to provide protection of principal, even if rates adjust upward, with the potential to produce meaningful appreciation in addition to income if rates come down. So what's the real deal? Stretched U.S. equity valuations are resetting lower, catalyzed by tariff and policy developments. International equities remain more reasonably valued and have held up better through the current uncertainty. Fixed income played its role through the concerning start of the year in U.S. equities. Playing without the goalie might be exciting, but it's rarely the winning strategy. And a more conservative approach to investing in 2025 was, and still appears, warranted. We stand ready to adjust portfolios as market prices move and new levels of earnings are realized. Thank you for your time, and I hope you tune in next quarter as we dig into the economic data and sort out what to ignore to get at the real deal.